You're going to give it me.
I'm going to call this meeting to order. I can. Ben, would you start us off with?
You got the minutes to review.
Oh, we have to approve the minutes.
We got a
My
quorum.
critics will have a fun one with this. Can we do a roll call vote, please?
Denham,
Here.
Fenton, LeBlanc, Pinkley, Williams,
Here.
Yancey,
Here.
Stepp, Milton.
Here.
Mayor, we have a quorum.
And for the record, when Kathy comes back in, we'll show she's present. Everybody had a chance to review the minutes from last meeting? If so, I'd entertain a motion to approve.
I'll make a motion to approve.
Second.
We have a motion and a second. All in favor say aye.
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 Opposed, same sign. Ayes have it. Next on the agenda is to acknowledge the disbursements of $50,000 and over for August 2023.
And we're going to start seeing a lot more expenses come through, I think, because as capital, as you know, last year was, when we passed the budget in 23, there were some massive capital projects come through. So you're going to see more and more of those expenses as we go through. About halfway down this page is fire station design, fire station 4 design. So Ted is starting to spend my money. That's unfortunate. No, but you're going to see some of this come through, which is not a bad thing. It's actually a really good thing. Put that money to work. Next thing on our agenda, though, is the investment report. I think this is going to be important because of the timing of what we've got going on.
Excuse me, Ben.
Go ahead, Mayor.
Do we need to approve those disbursements? Acknowledge. Entertain a motion to acknowledge the disbursements.
I'll make a motion to acknowledge.
Second.
We have a motion and a second. All in favor say aye. Opposed, same sign. Ayes have it. Thank you. I'm sorry, Ben, what were you
That's
saying?
right, thank you. So this next item is really good timing because this body is going to get together with the full board to go through our budget in October 26th. And so what Patrick's going to do is, the point of his presentation really is to give you guys an investment report where we're at. But the advantage we have is having him in the market all the time, watching key indicators, right? And he's got, part of his presentation is based on that, showing some of those key indicators. And so what he's probably going to do, what he's going to do in the charts he's got is expand on what I've already told you a couple months ago. But as he'll talk a little bit about the economy and how some of that will change, potentially change what we look at. So feel free to ask questions, but he's got a presentation. I'll go ahead and let him go through it. Patrick?
Well, good morning.
Morning.
As always, thank you for letting me come down here and present. I enjoy coming into Branson often, so appreciate that. As I go through this, if you have any, I like to do like informal presentations, so if you have any questions, just raise your hand or something. We can kind of talk as we go through, because there's some of this presentation that I might run through pretty quick and then maybe come back to towards the end too. So, and I hit the wrong button. Technology is like my biggest issue. I can talk about economics, but I can't do anything with technology.
You can't be great at everything.
And I'm not. Can I keep that disclaimer out right now? That's not an exact science, it's an art, trust me. Technology and economics. Anyway, I'm just gonna kind of go through, kind of give you a recap. You can see on this particular chart that, we've got kind of the treasury curve, where it's been and where I think we're gonna go, and we're gonna talk about that. Fed funds futures. I think there's a lot going on right now. The Fed just met last week. You're hearing a lot of rhetoric, you're hearing a lot of opinions on the news about kind of the direction of interest rates. And what my goal this morning, real quick, is to kind of give you my opinion and what I think is going to happen. We can look right now at this particular chart behind me. It shows you the Fed funds futures as of a couple of, like 2 weeks ago, I guess. And you can see that going forward across the way the Fed, what they broadcast last week is that they're probably going to raise rates maybe one more time. Right now, we're sitting at a 5.25% to 5.5% range on Fed funds, and so possibly they may raise again and go, 5.5 to 5.75. But what you have to remember is just think how high the Fed has raised rates the last, 2 years. I mean, the yield curve started to invert in March of 22, and typically that's like a signal for a recession 18 months later. Well, here we are 18 months later, and we don't have it yet. The yield curve is still inverted, and the Fed is still trying to fight inflation, and that's what we're going to talk about a little bit more too. Going forward, we look at this all the time. We kind of try to gauge what we think the Fed's going to do, and there's a market that kind of, just like anything else, there's a market that kind of trades out there and tries to forecast what they think the Fed is going to do. So at this chart, there's a 46% chance that the Fed should hike sometime between now and the end of the year. And once they do that, like I said earlier, you have to take into consideration all of these rate hikes that they've made. It takes a long time for that to filter through the economy. I mean, we're just now starting to see like the effects of high mortgage rates. You're starting to hear more and more. I'm sure some of you on the board are business owners. You're seeing your borrowing costs, increase dramatically over time. And so all of this, the goal is to slow down the economy so people, we slow down inflation, we slow down growth, and kind of so we don't go, we don't get in rates going too high. So if you look at this, you can see that what we're kind of predicting is that by the end of 2024, there's a possibility that there may be 3 to 4 rate cuts. Granted, if you look across, it's just going to go from being over 5% to probably a little bit less than 5%. So relative to the past several years where we had 0% interest rates, these are still very good rates. Like, back when everybody was flush with cash, rates were horrible, right? And that happens, there's a thing called like the bond trap. When we look at fixed income investors, and I could show you a chart, but everybody, when rates are low, everybody's flush with cash. If you go back in time a couple of years ago, we had the CARES Act, ARPA. I mean, these are all programs that Branson was a beneficiary of. You got money. All the individuals in the economy also were getting, stimulus checks. Everybody had high savings, but rates were zero, right? So no one was getting anything on their money, but they were out trying to spend the money to try to grow the economy, and that was the goal of what the government was doing. And what we're trying to do now is trying to unwind all of that. And that's going to be the hard part. And that's what we're quite frankly, we're in somewhat of like uncharted waters, in my opinion, because we've never had, at least in my lifetime, we haven't had a pandemic. I've never seen anything like this before. And this, unwinding of it is interesting to watch. Again, another recession probability forecast. I mean, there's a 60% chance of a recession coming. And again, if you look at this was a little while ago. As of the middle of August, they're still predicting a 60% chance of a recession. And that's because this is an art, like I said earlier. The Fed is trying to do, you probably heard the same phrase, soft landing, right? Everybody wants to have a soft landing where they can raise rates high enough to cool the economy down, but not slow down growth to the point that the economy is not doing well. And so that's what they're trying to accomplish. CPI, we talk a lot about CPI. Last couple weeks ago, we came out with the August headline number. It was 3.7%. I just looked in my notes. The next meeting is going to be I like to give you guys things to talk about or think about going forward to watch the news, but I think it's let's see, October 12th will be the next CPI number, and you'll be hearing about that, I'm sure, a lot on the news. It's 3.7% in August. In September, they're expecting the number to be somewhere around 3.6. So it's coming down, but it's still coming down pretty slowly. But we're way off of the highs. Remember, a year or so ago, we were like 9%. I'm sure you guys all saw, like articles how you can go buy the savings bonds, whatever, that were earning 9%. And those are unprecedented rates. Inflation was so high. And so hopefully you took advantage of that and got some for like your personal account. Again, things we look back on, and we look back on history. History usually repeats itself. The four most famous words on Wall Street, I'm sure you all heard about it, is this time is different. I'm not 100% sure that this time is going to be different, but we're getting ready to find out. I mean, I've been doing this for 25 years. When the Fed raises rates this quickly, it usually puts the economy into some type of an economic slowdown or recession. And so we can kind of go through here, and you can see when the 5-year Treasury, when it peaks, you can see that what happens, how many months after the peak when a recession begins. You can kind of go through the chart, and historically this has always happened. Where this chart, I left it in here on purpose, but the 5-year Treasury a year ago peaked at 4.5, then it kind of leveled off and dropped, but today it's like 4.66. So now all of a sudden, this peak is getting higher than where we thought it was going to be. 10-year Treasuries are, similarly 4.6%, somewhere in that neighborhood. 2-year Treasuries are like 5.09, I think, this morning. Again, we have like this whole economy, employment. I know that's an issue down in Branson. It's an issue everywhere you go. It's hard to find people to work. We look at, late cycle, where the employment rate is. And again, usually this should start to tick up. That's a sign that things are going to start slowing down. And again, we talk about the yield curve. The yield curve inverted in March of 2022, as I mentioned before. That's usually a signal of some type of an economic slowdown that would occur sometime 15, 16, 18 months later. And we haven't seen that happen, but the yield curve is still inverted. Like the difference between the 10-year Treasury and the 3-month Treasury is what we look at. That's what you want to follow. It's still over 50 basis points. So it's been that way for a long time. It's still staying that way, but what will happen is the Fed keeps raising short-term interest rates. That's why you see that front end of the curve go up. It usually goes up in lockstep with the Fed rate increases. Just again, another example of how long it takes and then how much rates fall. And so that's the biggest issue as we go forward in time. When this does occur and the rates start to fall, this is just an example of how much they fall, and they typically fall quite a bit. And so the Fed has to cut rates quickly to get the economy back going again. Like I said earlier, it's an art, not a science, because there's no rule written, to how to manage the Fed funds rate. I'm trying to go fast. Again, so a couple things that I've been watching, and as far as like the account base that I work with, why the yield curve might be correct. I work with a lot of financial institutions, and what we're seeing and what I'm hearing from a lot of my clients in that client segment is they're starting to tighten the bootstraps. They're starting to see some stress with some of their borrowers. They're starting to see that things don't cash flow as much at the higher interest rates that we have today. And so what they're doing is their job is to manage risk, right? And so they're trying to figure out, do we need to continue to make loans at the same rate that we've been making the last several years? And the answer is no, because even though their margin is increasing, but the creditworthiness of their borrower isn't quite as good as it used to be. And so this is another signal that if you can't go out and borrow money, what happens to the economy, right? And how about this, kind of a sidebar story? Again, I'm sure you're watching the news, but did you see over the last couple of months, several banks have been downgraded? Big banks have been downgraded, and they've been downgraded for a couple of reasons. One of them is the lack of capital. Their capital numbers aren't as good as they used to be. The other one is, and we can talk about this a little bit, the bond losses in their investment portfolio. All the bonds that they bought when they had all this money are now underwater, and they're at losses. And so what they're doing is that if you want to slow down the economy, the very number one thing to do is start downgrading banks. Because when they get downgraded, what do? They're going to they're tighten the bootstraps, right? They're not going to, the more loans they make, the riskier their balance sheet looks like. And so they can sit in Fed funds, or they can buy short bonds, or just buy bonds and not worry about, risking their capital. So that's something to kind of keep watching. If the Fed continues to downgrade a lot of these big banks, it's just going to put a damper on their lending activities.
Hey, Pat, can I ask a quick question?
Yes.
Is the downgrading of the banks a result of changes in what those numbers are that the federal government wants to see? You know what I'm saying? are the rules changing and therefore the grades change as a result of the rules changing? Or have the rules stayed consistent and it's just more and more banks aren't meeting those consistent historical rules?
It's, the rules are fairly similar to what they've been, but the bank balance sheets have changed, right? And so when they look at the capital ratios, like when you look at investments are the least capital intensive asset on a bank's balance sheet. Loans, I mean, they have to allocate, 100% risk-based capital. So they have to allocate capital to all these loans. And so what they're trying to do is they're trying to make sure that the banks stay safe. We don't want to have a repeat of like 2008 when Lehman failed and all different banks were starting to fail. And I mean, there's been one bank that failed recently in Kansas, but that had something totally different. It was, and I could talk to you about that offline somewhere else. But like with Silicon Valley, and the world's changed. And like Silicon Valley, the different banks that failed in March, that was because they had a different business model. They had a big investment portfolios, and they had clients that they wanted to have lots of deposits on file in order to do business with them. And so what happened is, as word started, that's the thing. Right nowadays, it's just different. In the old days, if you wanted to withdraw money out of a bank, you had to take your car, drive up to the bank, fill out a withdrawal slip, or go through the drive-through or whatever. Well, what happened with Silicon Valley is, I think I read somewhere that $40 billion worth of their deposits disappeared like in an hour because, you could just do it right here. I mean, it's just amazing how much technology has changed banking. So to answer your question, I think that they're just trying to shore up and make sure they don't have any of the same problem. I mean, and we don't, I don't think. I mean, bond losses are unrecognized losses. Things are maturing every day. The banks are getting healthier and healthier. But if you're sitting there in a bank and you continue to grow, you only have so many earning assets, right? And so your bond portfolio, you bought all these bonds when rates were at historic lows. I mean, they were 0%. I remember talking to people, if you could get like 0.01, it was like, score, it's not negative. I mean, the treasuries were negative for a period of time. And everybody was flush with cash, so they bought a lot of things. All these bonds that they purchased are now worth less than when they bought them because rates have come up 550 basis points. And it's hard for them to grow out of that, if that makes sense. So you've got these assets that are earning a low interest rate, and then they're trying to make more loans at much higher rates, but they also have to allocate more capital, and so you kind of just have to grin and bear it. So like if you're a publicly traded bank, publicly traded banks have it a lot more difficult, in my opinion, than like a family-owned bank, because a publicly traded bank is managing their financials or their balance sheet quarter to quarter, right? Because these guys all have to worry about what their stock price is. If I'm sitting, in Kansas City at First National Bank and I own all of it, I'm like, okay, yeah, I'm making less money today than I was 5 years ago, but I don't care. I mean, if that makes any sense. But the regulators in banking, a little bit different than municipalities. Banking's totally peer-driven. It's what everybody else is doing. And sometimes what everybody else is doing is good, and sometimes what everybody else is doing is bad. So you just have to be careful. It's a weird business from that perspective, if that makes sense. A couple more comments about as far as stresses that I think on the economy. I mean, we're starting to see, I think I talked about this even when I was here in March. I mean, credit card debt continues to increase like you wouldn't believe. So all of a sudden everybody had the stimulus money, they had savings. That savings has been depleted. They are now looking for other sources of income. Where can you go? So people are borrowing more money from their credit cards. Home equity lines of credit, I think, are still going to be, you might see more of those in play too, back like we had before the Great Recession, because everybody's values in their house skyrocketed, and people aren't moving. I mean, if you live in a house and you have a 2 or 3% handle mortgage, and even though your house is worth double what you paid for it, if you were to go move somewhere, it doesn't make economic sense, right? Because now you're going to buy a new house, it's going to be inflated, just like yours is. But now your borrowing costs, instead of being 3%, are now over 7%. So no one looks at like I've always said, I'll pay an interest rate. I don't know if I have any bankers here, but I mean, I'll pay somebody an interest rate, but I want to buy that asset for like 50% of the cost, right? I mean, that way it works. But if you're paying an inflated value for the asset plus a higher interest expense, I mean, it doesn't make any sense. So that's why you're seeing, in my neighborhood, I live in Kansas City, up by kind of by the airport. Houses, my sister just sold her house in one day for like double what she paid for it. I mean, it's crazy because there's a short supply of homes. And so the people that have to move don't have a choice, right? But to pay the inflated value. So, which I think that I I don't think that's a good thing. I think that over time, that's going to be a problem because this person just bought the house for way more than I think that it's worth at some point, and they did 100% financing because they threw the loan to the bank that gave them the loan, and I think that just creates more problems down the road because that asset's going to be worth a lot less than what they borrowed. That's just my personal opinion. Quick couple more comments. Let's see. Again, as we've had, if you go back historically in time, this goes back to 1970, you can see that whenever we had high periods of inflation, typically it was followed by some type of a recession. And so again, just history usually repeats itself. I mean, we've had rampant inflation because of all the money that has been put into the system, the excess liquidity. And so at some point, I think as the Fed's raised rates so fast that I think we're going to have some type of an economic slowdown or a recession again, but we'll see. Savings rates, I've kind of alluded to that a couple of times as we've gone through. Savings rates you can see on the chart during the pandemic were astronomically high compared to the past, and that's now come down, and which stinks, right? All of a sudden, you can go out and buy a 5% CD, but nobody has any money. And when everybody has all the money, rates were practically zero. And so that's just that bond trap. It's happened throughout my career. It'll continue to happen, and that's just kind of where we are. A couple other comments to make about the consumer. Does anybody read the Wall Street Journal? There's just an article in the Wall Street Journal a couple days ago about a quadruple effect, kind of getting ready to hit our consumers. I drove down here last night, and gas seems to be a little bit cheaper down here than it is in Kansas City. But we have $100, almost nearly $100 barrel oil. I mean, a couple of years ago, gas was down to like $1.60 a gallon. Now we keep getting closer and closer to $4. That's a tax. That's expensive. That cuts into people's budgets. This UAW strike doesn't help when you have people out of work. We have this isn't part of the Wall Street Journal. Well, I guess they did talk about it. The pending government shutdown, which could happen this weekend. I don't think this will have a huge effect on the economy just because this isn't part of the debt ceiling. This is just them trying to cut some spending. It's very political. So, I'll leave it at that. And hopefully they'll get something. McCarthy was on the news this morning, so hopefully they'll get something passed this weekend. But I'm not too optimistic that will take place. And if that happens, that stinks for all these government workers. I know people that work for the government. The best part about this, I guess, for them is typically they get their back pay, when they start back up. So it's kind of like a vacation. But again, it still slows down. They don't spend money. It'll hurt the GDP for a temporary period of time, but not a lot. The other one that we start hearing more about October 1st, the student loan debt payments resume, which that's a big deal. People have had a couple of years of not making those payments, and all of a sudden they're gonna, that's gonna cut into their budget, a couple $100 a month. And I think I read somewhere too that if they don't start paying it right away, there's some type of it's like 6 or 9 months before they really start to come down on them to make sure they're paying it. So there's always, I don't know, when I owe people money, I try to pay them on time. So that's just me personally. And I talked about the oil. Oil, I drove around a couple weeks ago, and there was different places that I went that gas was over $4 a gallon. So, I mean, it keeps creeping up. That's more of an OPEC issue. They are, they're reducing production, and, which, again, there's a lot of politics involved in all this that I'm not gonna go down those roads, but it still hurts all of us in our checkbook. Again, just another example. You can kind of go through here and look at where treasuries were. Look at the blue line 3 years ago. I mean, you can see that, there wasn't anything that yielded over 1%. 12 months ago, I mean, we've kind of started to get into 2s and 3s. Now we're 6 months ago, 3s and 4s. A month ago, now we're in 5s on the short end of the curve, 4s on the latter part of the curve. And then if you look, a month ago and today, like some of these numbers have changed a little bit, like the 2-year treasuries now, 5.09, 5-year treasuries, 4.60. So after last week's meeting, the rates jumped up a little bit just in anticipation of this, possible one more rate increase before the end of the year. And this is, I could come back to this, but but I like this chart, and I think this is something that you guys should pay attention to, because like going forward, every dollar that's invested is going to be invested at a much higher rate. And so this is a yield matrix that we like to put out, and it goes, you can just see if you look across it, everything's based off of the treasuries right here. Because treasuries are the gold standard, right? I mean, treasuries are 100% guaranteed by the government. Then you run across, you look at bullets, these are callable agencies, CDs. And you can see that CDs are just a little bit, depending upon the maturity, they're kind of right in line with treasuries. And so what happened, there was a period of time this year where CDs were actually yielding more than treasuries, and it was because banks needed deposits. That's the other thing you start seeing on the news. Banks need deposits, they're having to pay up for them, and they're hard to come by. They're really hard to come by, because what's happened, I mean, I don't want to do a show of hands, but a lot of people now have like Fidelity accounts or Charles Schwab accounts. I mean, with the internet and television and the media, everybody's starting to find out that, you know what, there's better rates out there sometimes than what the local bank is offering. I mean, the local bank just wants cheap deposits, right? Because that's how they have a wide margin to drive their revenue. And so you're starting to see a lot of money run out of banks, and that was the problem with Silicon Valley and everybody else. Of course, it was fueled more because of a fear of failure, but you're still seeing a lot of the financial institutions that I work with, that's their biggest challenge today, is funding their bank. And and especially if you're in a small rural area, it's hard. You only have so many deposits to gather, right? And then so you have to go out and maybe do brokered deposits or Federal Home Loan Bank advances, and those are typically a little bit higher than what you could get from your local customer base. And so, again, all of these yields, they ebb and flow, right? I mean, as treasuries move, all these different securities have different spreads over treasuries, and then the spreads change for various reasons. Sometimes, municipalities, not Branson, but other municipalities have credit issues, so their credit rating drops, their yield drop, the yield has to go a lot higher, so their spread would be higher than anything else because it's more of a risky investment. Same thing with corporates. We're looking at maybe an economic slowdown. You start seeing, stocks of the big companies, have problems, raising prices or selling their goods. So those corporate yields should widen. Those spreads should widen over treasuries because they're riskier than treasuries. So what we do once a week is we try to put out, if you see, how do I go back? If you go, we highlight in red kind of where the highest spread is for every maturity. You can see right now, they're callable agencies. But see, with Branson, the state statutes state that you can't invest past 5 years. So, but, I mean, and think about it. Who in their right mind would want to invest, at least that far out? Typically, people don't do it. It's human nature not to go that far out. And then the reason being is these all have call options. So if you buy a 7-year final maturity, something that comes due in 2030, it'll have a 1-year call option. So that agency, Federal Home Loan Bank, Fannie Mae, Freddie Mac, whoever it is, they have the right that if all of a sudden the Fed starts to cut rates, they call that bond away from you. So that's why they try to bait you to buy them now, but you typically won't have them till maturity. And so those aren't good investments. And I'll talk a little bit more about that later. Any questions thus far? I know I'm going fast. So we get into the city of Branson. So here's the portfolio as of the end of August. There's $70 million in investments. Your tax equivalent yield right now is 233. It continues to go up. This is just as of June. Like in my notes, it was June of 22. The yield was 123. The duration was 2.82 years. So everything continues to shorten. The yield is lower, but as all these bonds start to roll off, everything's going to be reinvested at much higher yields than what we have in the portfolio, just like everybody else. So the fact that you have a 2-year duration, you don't have a lot of optionality, kind of sets you guys up in a good shape. So every dollar invested going forward, you should earn, a couple hundred basis points over what you're getting today. So that's something that you guys need to, as you do your budgets and stuff, you can at least know that you're going to be earning more money from the investment portfolio than you have in the past. Questions on this? There is, the gain and slash loss, there's a $70 million portfolio. You have almost a little over a 4% loss, the 3.5 million. Not uncommon. That's actually fairly low compared to some of the portfolios that have longer durations and longer average lives. So they buy longer bonds. Those have they have a greater fluctuation in their market value. So the fact that you guys have a 5-year stated finals in your investment policy keeps you guys from getting too out of whack on anything. So that's a good thing.
Patrick, I do have a question, and I may be premature asking this. I sit on the committee on a bucket of cash. And for several meetings, they continue to ask the question, provides a report. And as you mentioned, they are offering 5% or slightly over 5%. So the simple question is, if we had, give a number, $10 million, why wouldn't we move that into something that earns 5% versus?
Nope. Great question. So I show, like as of today, there's a little over $5 million invested in that account. And what it's earning right now is $475. And so it's in a ICS account, an insured cash sweep account. And so what that is you get daily liquidity, you get daily access to those funds. Like if you wanted to pull out money tomorrow, you can. Next week, you can. And so what we could do with this money is we can find out like a maturity horizon, or how long you think you're going to not need that money. We could start taking that and deploying it into shorter treasuries where we can get greater than 5%. But this yield is a little bit lower just because you have the daily access. But if we go in and start terming it out a little bit, just back if you look at that chart, we can just start putting it in some, really short, even 6 months is too long, but 3 months or whatever you guys think. If I get some type of an idea of when you'll need those funds, we could put together like a proposal and say, hey, we can, here would be an aggregate yield. We wouldn't invest it all in one bond, but we could take the $5 million and invest it into 10 or 20 different individual securities that would get a little bit over the 475.
I believe the question on the table was, and you're the perfect person. What I'm hearing from them is there are brokerage savings accounts where your cash is liquid that you're getting more than 5% on the money today.
Yeah, and that's typically the state statutes say that you're not supposed to invest state or city money in government money market mutual funds. So, because they're not insured. The ICS account is 100% insured, because what it's doing is it's investing in CDs across the country. So if something were to happen and a bank were to fail, you would never lose $1. In money market mutual funds, back in 2008, some of them broke the buck, and you could actually lose money. And the state statutes in Missouri say that and municipalities I know do it all the time, but you're not supposed to be doing it. That's why I haven't recommended it.
So let me be more specific. You just said that out of that 76 CID, you said there was how much invested at the 4.75?
5 million.
Do you know what the other 5 million's doing?
I don't see the other 5 million. It's probably in a bank account.
Yes, please.
The rest of the 5 million is in the operating account for the 76 CID, and it is, now I didn't check on the August bank statement, but I believe the July bank statement, it said 4.26%, and that's off the top of my head, so I know it's over 4.
So then, roughly, 5 million is earning at 4.75, the other 5 is earning 4.26.
Correct.
And those are fully insured accounts.
Both of them are, yeah.
Yeah.
Yes.
So that'll answer the question at our next 76 CID meeting. Thank you.
And I can get you copies, if you want them, I can get you the bank statement that has the percentage on them.
Would you do that and provide it to Ben, please?
Yes.
And I could also do the same thing. I could put together, some type of I could also put together some type of a proposal, that you could take back to them as well and say, hey, it's all about, when do you need the money? And that's the challenge. I mean, a lot of times, the liquid accounts are going to pay less than the termed out type accounts. So that's just the way that works. But if you decided that, and that's the feedback that I need, is that if out of that $10 million, you think that only $3 million you're not going to use for a year, then we should invest it out longer and make more money. We just need to figure out what that number is.
Okay, and so I guess the same question, we can keep it simple, but with all the other funds that the city has, liquid funds, if I understood this, we're currently earning 2.33%. And so the same question would be asked if with the,
We'll finish it. I'll let you finish your question.
you got it?
Well, the point is that we just invested like $5 million like a couple weeks ago. And I think that, everything that we purchased was, 460 or over. I mean, it was close to, we bought, everything was, I take that back, everything was over 5%. So we got yields and we invested stuff out, we just laddered it out a year. So we did stuff we did like a farm credit in December at 568. We did a farm credit and another one in December at 574. December of 23 at 573. We bought a treasury bill because it wasn't, as the farther you go out on the yield curve, the less, narrow those spreads are. And so like if you can't find something that's going to beat treasuries, right, buy treasuries. So we bought a treasury bill at 540. We bought a CD at 540. We bought a $1 million block of a treasury bill at 530 due in April. Another CD in May at 540. And you can see these rates are they continue to, they go down just a little bit, but still if the Fed were to start dropping rates sometime next year, then these would be good bonds to have. But the point is, going forward, it might make more sense to start to lengthen again, just to lock in the higher rates when we think the Fed's going to start to cut. So we're doing that now. We're starting to put some of there hasn't been a ton of money to invest, and so the money that we've had, we just deployed at much higher rates. So the point being is that every dollar invested going forward should bring up that 233 average.
So what's driving that, with the rates we're talking about, 5.6, 4.75, what's driving our average down to 2.3?
It should be going up. It's going up. I mean, if you go back to the, it's going up. See, just in June, it was 227, now it's 233. And then if we run these numbers again and like get into November, that 233 will be higher. But it's only, it's 5 million of 70 million, so it's not gonna move the needle from 233 to 4 like overnight, but it'll continue the trajectory will be higher going forward.
Okay, so basic question, why isn't the 70 million earning 4.5% versus
Because it was all
2.3?
invested back when I showed you the yield curve when rates were so much lower. Just in the past 18 months, the Fed has just ramped up rates, and we've had less money to invest. Like when you had CARES Act money and ARPA money, all that money was distributed when rates were a lot lower. I mean, you can't just, and so then the logic behind some of this is when when we think that the rates are going to start to fall, I mean, we try to put some money out where we're going to get we don't want to have the call options attached to, like I showed you, like on the callable agencies. So we try to find bonds that yield way more than treasuries, but give you like a treasury type cash flow, that locks it in for a while. And so what's happening is this tightening cycle is just, it's befuddled a lot of us. It's lasted longer than we thought it would. It's taken the Fed more time to fight inflation, hence the number of rate increases.
So am I hearing you correctly that out of the 70 million, sounds like a good percentage of that has already been locked in?
Yes.
At lower rates?
Yes, and as it
Which
matures.
is bringing our average down.
Right, and as it matures, all these numbers should continue to increase. And that's what's happening in every fixed income portfolio around. I mean, every dollar that matures today is good because it's usually got like a 1 handle or a 2 handle and so now it's going into a 4 or 5 or, I mean, you can even get even higher rates if you go out farther. Yes.
Yeah, Cherie, Jolene, and I met with Patrick about the very same thing. And it's, the way I would look at it is the same as what Patrick's talking about. When we're sitting at a market where we're earning interest at a 0.25%, everybody was clamoring to get 1 and 1.5%. If you can get that for 2 years, not knowing where that rate is going to go, we thought that was going to stick around for a while, right? I'd buy a 2% CD or anything at that length for at least 2 years. Then we'll see what happens. Well, if that happens, and then the interest rate goes like a rocket up, okay, now we're stuck with that 1 and 2, and it flipped on its head. But what Patrick's working on for us is, okay, how much of it is coming off, and what's your prediction for moving forward? So what's that 2.3 look like moving forward? And that's what he's working on for us, given our current investment strategy. Because if we stick with some of the longer term at a 5%, we're in the same position we were 3 years ago. Maybe that 5 goes to 7, we just missed the 7. So whenever we have a investment policy, you got to have investment policy based on maturity and then based on type of investment you've got, CDs, brokerage accounts, but everything has to be insured, obviously. So it's a delicate balance, especially within this economy like Patrick's talking about. Yeah, but we're working on it,
Yeah,
definitely.
thank you for that. And Patrick, you really answered the question. Because at an elementary level, right, why are we earning 2.3 when the market out there is 4.5 or 5? But thank you, because you answered the question. We are locked into those rates that Ben was talking about.
Right.
Which is driving our average down. So that's the answer to the question. So
And
thank you very much.
And it's like this everywhere. Every municipality, every financial institution, every corporation, anybody that I work with that invests in fixed income, we have these losses. I mean, it's unfortunate. And so, but yeah, so again, going forward, we should expect, even if the Fed were to start another like easing cycle in a year, I mean, think about it. So say we just stop at 5.5 and then they drop rates 75 basis points, we're still at 4.75. We're still going to beat everything that we have rolling off.
Yeah, no, I'm with you.
I mean,
now.
unless we have barring some, I mean, these are like this pandemic. Nobody predicted that, right? I didn't know they were going to drop rates to 0. Nobody did. I mean, I didn't know that we were going to shut down the economy for 3, and so these were things that were, we've never had to deal with. So the good news is, like I tell people, the good news is you should have much more interest income going forward.
So all we need from you, Patrick, is for you to know factually what the rates are going to be in 12 months from today.
Yeah,
And
that's-
24 months from today. Then today we could make better decisions.
There's a ginormous disclaimer at the back of this presentation for a reason.
Again, Patrick, thank you for that explanation.
So, I mean, and the point, the couple of comments without getting into the weeds, and I can, field more questions if you want. I mean, I have lots of other charts and stuff on here, but, you have very little interest rate risk in the investment portfolio, and that's a good thing. So, like, I mean, I know the losses are concerning. I mean, I get that. I hear that from everybody every day. But like the losses that you have, trust me, are less than what they could be if we had more what they call optionality in the portfolio, and that's like those callable bonds. And so, like, what happens is if rates are high, they call those bonds away from the investor, and you're forced to invest at like a lower rate. And so, but then if rates are low, it's just like refinancing your mortgage, right? If rates are low, you're not going to refinance it. You're just going to roll, and then the bank's stuck with that 3% mortgage. And so they're the ones that are, like, all those loans on these mortgage company books are at losses too, right? Because they could be making 7% mortgages today, but I mean, they're not making near as many as they would like. That's for sure.
Again, yeah, thank you very much for that explanation.
So, yeah, so I can, you've got your cash flow, I guess, would be kind of where I'd stop. This is what I like. I mean, you have a 2-year duration. To put it in numbers, I mean, there's, 77% of the portfolio, or $58 million comes due within the next 2 years. And that's, or 3 years. I mean, so that's $33 million year two. So we have lots of dollars that we should be able to invest at a lot higher rate. So, like I said, I could get into more and more of this, but, and there's the disclosures for you to read.
Yeah, we should stop and I'll read this.
But that's, for the sake of time, that's kind of my, I'll kind of wrap up here. But let me know if you have any questions.
I truly appreciate this update.
Well, and I could come down more often too. I mean, that's the other thing, is we have more of a dialogue with the new finance director. I mean, I'm more than happy to, it's a short drive, and I mean, if you need me to come down, or I could even bring down, like, we have an economist that would love to come present. He's spoken at, like, some of the, like, the GFOA type conferences and whatnot. That might be a good thing, and.
I
so
think
just-
it would be very good to have the economist come down.
Because he would,
and
I get a lot of
very
my.
educational.
And he's really good. Steve Wyatt is his name. He just lives in Tulsa. It'd be a short drive. And so I could, if we would to coordinate in the future, I could come and give you like a quick update on what we've been doing with the portfolio. And he could give you a half hour, really deep dive of what he thinks is going to happen with the economy.
You could show us where the rate, our return's going up, right?
Well, I'll do that first.
Yeah, but I just think, what you just shared, letting our aldermen and the public know that, I mean, that's a real simple answer to why are we earning 2.3? Because earning, on the surface, the headline is, Patrick, you're not doing a very good job.
Right, yeah.
Because we're only earning 2.3, and I could take the money to Schwab today and make 5%, so. Right?
And that's something, I mean, if you guys want to look at that's, there aren't any municipalities that are doing this, but there are financial institutions, insurance companies. I mean, if you were to take, I could maybe just for fun sometimes show you the math behind it, but you could do like a bond swap. But that's the problem with doing a bond swap, is that you would have to incur a loss. I mean, you would literally incur a loss. Like right now, you're not incurring a loss.
I think that topic is in your wheelhouse. I don't know that we need to understand that world. We need to stay at.
I can at least show the math sometime. Okay, and it's easy. And the way people look at some of those types of transactions is, if I can sell these, like, and pardon the way I talk about this stuff, but I like to make it simple so everybody understands. You sell like the dogs of the portfolio, like the ones that aren't yielding very much. So what we do is you just take that portfolio, sort it from like lowest yielding asset to highest, right? Then so you start looking at those crummy ones, and then you go get bids on those and see what the losses are, and then you could sell them and then reinvest into like the 5% type assets. And sometimes, with the yield curve, if it's steep enough, you can recover the losses very quickly, and the math proves itself that you can say, okay, it's going to take us within the calendar year. We won't have a loss through our fiscal year, but going forward, we're going to be earning this much more interest income. So that's just, I mean, I'm just throwing that out there. Sometimes it works, sometimes it doesn't. But typically municipalities, the ones that I work with, losses are not.
Yeah, so Ben, if you would coordinate, have Patrick get the information to Cherie. Okay?
Yeah,
Thank
that's
you
easy to do.
very much, thank you.
All right, well, thanks again for having me.
The other thing is we've brought, whether Mark knows it or not, Mark Colossy, he's going to actually sit with us when we review investments, because what we want to do is make sure that it's not just the investment nerds like us that can understand what's going on. So he can ask questions that we're not thinking of, like what you just asked. We want somebody else to look at it as well. So it's in kind of, if anything, an impromptu investment committee. So we'll meet on a monthly basis, and Patrick will be with us, and we can kind of have some of these same conversations. And we'll talk about what he said about the 76 CID, it's the timing. So if we don't need that for 6 months, we may put more money in there at 6 months and maybe less money out 9 months from now. And that way we can kind of answer those Gail's questions on that too.
Thank you.
Now to the fun stuff. All the great news, right? The dashboard, obviously, you guys all know about the dashboard we put together. It goes through some of the bigger revenue pieces citywide. The sales tax right now, we're looking at year-to-date up 2.3%, and you're looking at September is not in here. You're looking at August, by September is actually 2.3% over last year, year-to-date. September itself is 13%. And that's about $1.3 million add to the budget.
Excuse me a second, Ben.
Yeah.
On the top right chart,
Yeah, that's got August in it. So August collections are itself 7.6% below August of '22. September came back to a positive. For the year-to-date, the sales tax is 3% above August of last year.
so the 3% we're 3% above August of '22,
Correct.
and then what is that percent for September?
September is 2.3%.
Above.
Yep.
So the year-to-date number through September would be,
Is there still about 3%?
okay, thank you.
Yeah. So what we're seeing is what we predicted last year, and everything's kind of slowing down, and that's actually what's happening. Everything's slowing down. We predict we're going to come back to kind of more normalized increases, and understand that's 3% above an already very high number. In some areas, they're starting to see monthly losses in sales tax as recession hits, as college payments start coming back. People, the households have less money, so we'll continue to look at that. I mean, just kind of a sneak peek on our budget for '24, we're looking at a 1% increase growth in sales tax across all sales tax collections. Last year, I think it was flat, and then on the tourism side, it was a decrease. So we want to be very careful with that because of how much our budget really leans on that number, that sales tax number. The public safety and transportation really kind of follow that same model in this case. The tourism tax year-to-date is up 4%. Here, August is above the same period at about 1%, which is what I thought it would be. We're 52% over budget, which is around $4 million. And remember, last year we decreased, we took, say, a tourism tax down based on the number that was already artificially low. So that created a fairly sizable gap. For the budget this year, we're going to close that gap.
So on tourism tax, what I'm hearing you say is, like, for example, August was down over last year. Are you anticipating, forecasting, crystal ball, the end of year '23, our total tourism tax will be equal to or slightly above last year?
Yes.
Thank you.
Yeah, that's right where we're at. With another, I guess in '24, we're looking at it flat. Yeah, we're not growing it at all.
And I'll tell you, if '24 would be flat, it'd be a great year.
Yeah, exactly. Yeah, no, right. You're right. Because it's more elastic than your sales tax. Let's go on down to the categories. All four categories we've got here, all six categories are up, with the exception of hotels, motels is down 1.7%, which statistically is break even. Amusements are flat, 0.13% above, 63% above 2019. Theaters are 12% above. Last year, 35% above 19. Hotels and motels I just mentioned, they're 19% over 19. Campgrounds, that's the one that's going to be important for our budget. We're going to be watching those campgrounds because the demand there is there. The campgrounds early on, remember, was negatives for first and second quarter. The campground season has hit us. Now we're 8.5% above last year, year to date, or 48% above 19. It's important in the budget because it's a mechanism we're using to be able to fund our intergovernment borrowing. And I'll get to that in a minute.
So Ben, for clarity, when you say we have to watch the campground numbers is such a small percentage
Right.
of the whole.
Right.
The campground numbers are important from the city side.
Correct.
Because of the city campground.
That's a good clarification. That's right. Yeah, yeah, because so the city campgrounds, right? That's the one we're going to be watching. And I say watching only because it's a good thing. As we start expanding the ability for folks to be camping here and bringing in their motorhomes and really expanding that ability to enjoy Branson, we're going to see that revenue go up exponentially. And that'll actually be a good thing. Nightly rentals are still 10% over last year, 165% over 19, so we're still seeing a lot of nightly rentals come in. And then restaurants and concessions, 7% over last year, with 13% over 2019. So overall, they're doing pretty well. We're seeing that's some of the growth there's a mix of that growth within the tourism area that we're tracking.
And for clarity, when we see these increases on these categories,
Right.
it's reasonable to assume that a good percentage of these increases is due to inflation,
Correct.
not due to more people coming
Right.
to Branson.
Right, right. And we would expect that from 21 to 22, prices have gone up. 22 to 23, they may still go up. How much is probably not as much as it was from 21 to 22. We'll look at this time next year. I'd expect lower percentages of that growth. If they're higher, they're more indicative of either expanded programs within theaters or higher tourism.
Or more visitors.
Exactly.
Yeah, thank you.
Exactly, yeah. Water and sewer, we'll come back to that during the budget as well. Keep going. And we mentioned that this is probably the best picture I can give you on sales tax and tourism tax. That orange line you can barely make out. It's good that you can make it out because then that means it's a skosh higher than it was last year, but it's following that same trajectory as last year. And tourism is a little bit, tiny bit wider than sales tax. But that trajectory is moving the right way. General fund right now is operating at a surplus. And we expect general fund to come out. It says 1.1. It's probably closer to $1 million that we're coming out at the end of the year. And that's that's before we account for any kind of investment losses. But it's the increase would be about $1 million. And that's the amount we tend to come back to you guys and scrape it off, put it over in savings for other projects as they come up. Last year it was 1.3, maybe a smaller number.
Ben, when you use the term investment losses, would you describe that, please?
Yeah, so we've got two types of investment loss. When we have an investment vehicle that we sell, we bought for a higher price, that is a realized loss. We sell it for a lower price than what we bought it for, that's actually a loss.
And when you say investment vehicles, you're referring to bonds?
Yeah, it didn't matter, it just investment number A. Yeah, it could be bonds that Patrick was talking about, when they call them back. We take that money, invest it lower, that's an actual realized loss. What we have is what's called a paper loss. So what he's got is our active investments that are in there, and we're not realizing an actual loss cash-wise. The value of those are losing value. So you can't resell them on the secondary market and get a gain on it. So we're going to see those. As they mature and get invested into something double that rate, we're going to see those gains come through. So it's not actual cash. Understand that's the other good thing that I wanted to mention. The investment earnings through August are double what they were last year, which were a skosh higher than what it was the year before. Our budget, I think 2 years ago, was $150,000. We've got $750,000 in the budget for this year. That's not in the budget. That's what our expectation is. Just based on what Jolene mentioned, the idle funds at a 4% rate is what we're cooking at. So even though there's a loss, there's a big increase coming in that's helping our budget. So we are enjoying a fairly sizable interest income coming in. That's a very good point, though. And it wasn't expected, obviously, within our budget. And then water and sewer are actually doing well, too. The The general fund is right at 67% of expenses, which is where it should be. That's what we're predicting. 67% of the budget. Water and sewer is less than that, obviously. 47% of the budget being spent with 67% expected. Then my favorite chart, the one on the top left is the tourism tax. You can kind of tell that next year or next month, I would expect August to drop the August point of sale to drop a little bit based on what the traffic counts have been. On the right-hand side, sales tax, we've got one more month of sales tax that we'll receive at the higher rate until we kind of start flattening out. So those are real good predictors as to what we think we're going to do. This was also a tool that I used when Colby and I started talking about sales tax for the rest of this year. We've got actuals all the way through August, and then when we forecast September, October, November, December, we just take what we received last year based on this and carry it over to the new months as if that's what we'd received. So we're not projecting any losses. We have a loss in September, then that'll obviously model that differently. But right now that we're projecting it flat right around the end of the year.
So Ben, if you wouldn't mind making an adjustment to this chart.
Yep.
I'm assuming when we look at the 21 and 22 counts, those are for the full month.
Right.
And so what's a little bit misleading is in the month of September on both charts, September's not over, so that's going to be a partial number.
Right.
So if we have partial numbers, let's not include it.
Yeah, you're a good point.
Because it looks like, holy crap,
Yeah.
the traffic is cut in half.
That's a real good point. I should have thought about that. The bottom part of this is just additional information. This is for the month of July. I haven't switched that out. Oh yeah, it would be for the month of July. And planning gives us this information. It shows the increase in construction value or the actual construction value coming through. And then breaking those out based on what those amounts are. Right now it's the existing commercial expansion at 1.8 million. On the right-hand side, you can kind of see what that adds up to, what's included in those. Moving on to cash balances. Operating funds are at the top. You can see the orange line is last year. The aqua line is this year. The decrease in cash balance for the general fund is just the move general fund money over to a savings account over an internal service. And that's two lines from the right. You can see that green line that went up quite a bit based on last year. That's really where that money's at, where that's sitting.
And on that bottom left chart, we can anticipate the public safety fire will dramatically decrease because we're using those funds
That's right.
to construct the fire department.
That's exactly right. Yep.
Thank you.
And so we'll see a fairly dramatic change in both of those, really, because we've got money on the police side as well to help pay for part of the police building. So Eric's got money sitting over there to help pay cash for that. One of the other things that I wanted to mention, this is the financial data, and I think that's the end of the dashboard. One of the questions that I know you guys ask is, we borrow from ourselves, and we have 3 times so far. The fire truck, the campground, and turf, we're borrowing from ourselves. We would typically go out to the market and borrow money in a lease vehicle of some type, and it's run around 4.5%, 5%. One of the questions you asked, Mayor, was what are we saving by doing that ourselves? We're doing it in bite-sized chunks. When I say that, it's $1 million, just around, it hovers around $1 million. I'd be really uncomfortable going out long-term with a bigger bond and doing that with ourselves. But on each one of those, it's around $300,000 gain. That's what we're savings over that 10-year period that we borrow from ourselves. Now, somebody can argue, well, that's money that you could have invested. Well, if we're investing at 2% right now, and we're going to pay 5% to somebody else, there's a gap there that we're actually saving. So I'm making the assumption that we're just taking that money and earning it through not having to borrow externally for it.
Yeah.
It also costs more. You get cost of issuance, you've got bank fees, you got all kind of things you got to throw into that. But if we've got the cash ourselves, we can borrow, we've got a mechanism to do that ourselves. And they still pay interest back to that fund, the tourism fund. It's not a freebie. So we've got that.
I'm just curious, when we have departments borrow from ourselves,
Right.
what interest rate do you impute on that?
Well, 2%. And they actually pay that 2%. That's what's built into the amortization. So there is a return on that. So it's not just free money we're giving to that tourism fund.
Very nice, thank
They're
you.
actually earning money on it too. I think that's all I've got there on the, yep, that's all I've got on the Get dashboard. And the financials we don't go through in detail, but if you've got questions, obviously we are absolutely available to answer anything. Because I know you've read every page of that. I know Pam does.
What a great and thorough presentation. Is there any members of this committee have questions for Ben? Ben, I know this isn't the right time, but it is our finance committee, so let me throw this topic out. There's been discussion that as we're on the doorsteps of talking about our 2024 budget,
That's right.
I can share with you that myself and a few aldermen are in favor of refunding, and Kathy, I'm not sure the name of that fund we had for nonprofits. Do you recall? You need to push your button.
Ted just sent an email, and I don't remember the exact name of it, but I informed Ben of your desire on that particular account, so we're working that through.
Okay, I just wanted this finance committee, right, to understand what it is that we're proposing.
Oh,
and
please
get a-
proceed. Yeah.
And get a blessing from this committee, so when it does go to the board.
Lovely, thank you.
Thank you very much. Any other questions? Nope. Ben, truly, truly appreciate you. Patrick, thank you so much.
A couple things in a report I just wanted to let you know. Cherie has hit the ground running. My life got a whole lot easier. Hers got a whole lot more complicated. We just shifted that. She's now finishing my sentences. That's really scary. It is really scary. She's finishing my sentences as we talk through things. I asked her a question this morning. I didn't answer her. I put 2 words out and she just nodded her head. She knew what the answer was. That's scary. But between her and Jolynn, they've been working their butt off on, their backside off on ERP, the finance system. And thanks to Chad and Cindy and their staff, that's yeoman's work. And they have been working a lot on that ERP. It's going to do fantastic things for the city. Just digitizing what we've got in paper is going to be huge. But making a process to where you can pull a phone up and approve something and not even be at your desk, that's going to be a great thing for all the directors who hate Naviline. We don't have to hate anything anymore. I mean, heck, I hate Naviline, but we're in it all the time. And then one of the things I wanted Cherie to talk a little bit about is one of your big rocks that she has got moving. If you want to come up here, please.
While she's coming up, Mayor, if I may interrupt, I want to recognize the finance staff. I mean, Ben, you hit on it, but I can't overstate this. They're doing their normal jobs every single day that they've been doing for years, which is a lot of work. And on top of all that, they're sitting through often all-day meetings to implement this system. HR is doing the exact same thing. I mean, it is a tremendous workload, and they are not complaining. They have cheerful attitudes about it, and are really working very hard to make the system the very best it can be. And I'm very impressed with Cherie coming in. She's been through these conversions before. She hit the ground running. She knows exactly what she wants out of the system. And I just want to take my hats off to them all. They're doing a fantastic job. We're working hard to keep the project on track, to manage the project. They are doing all the actual heavy lifting and hard work, and they're doing fantastic. So just wanted to recognize that publicly. Thank you.
Chad, thank you so much for saying that. And some of us here understand and appreciate how big that ERP system is. And it's going to take a few years to get it implemented. So what you just said is happening every day that most of us are unaware of, right? They're doing the regular job and this conversion. However, at the end of the day, when this we're already starting to see some benefits that you mentioned, but at the end of the day, that system that we're going to have in place will be absolute, full transparency to our community. It's going to make our city so much more efficient. So thank you. And I would also like to compliment everybody, all staff that's been working on this, because I know it's a booger to do that. Kathy, can we say booger and working their butts off?
You can say anything you like, Mayor.
Well, you know.
Well, within reason. Cherie, talk to me.
Okay, the short-term rentals, we started working on a couple of weeks ago. At first, we're just trying to find our way at first. We were combing through websites, and we realized real quickly that we needed to change our process because we wasn't getting the results we wanted. So what we decided to do was to do on-site visits. So we targeted an area that we know has a lot of short-term rentals, and they mapped out a plan before they went. These businesses we know are licensed through the city, and so they knew when they showed up which ones were licensed with us and which ones were not. And they took pictures, they found advertisements, they found all kinds of information. And then they came back and they've been researching it this week. And just from that one site visit where they walked 3 streets and gathered all this information, we found 33 properties that we know are short-term rentals that are not licensed with the city. So under full disclosure, they could eventually fall under like a master's agreement that somebody hasn't updated. But we're just really happy with, our progress, and we're hitting it hard, and we're working on it every week.
So Cherie, you obviously know that is music to my ears. I do believe, and many of us believe, that a sizable amount of revenue is being left on the table. It's also not fair to those that are licensed, right?
Yes, sir.
And so in addition to your day job, in addition to the ERP, you're also moving big rocks.
Yes.
Thank you so much. That will make a difference in our finances. Thank you very much.
I'm really proud of my team, and just FYI, this is Finance and Accounting Appreciation Week, and just a shout out to my team because they're amazing. Yeah.
I did not know that. Kathy, did they get cupcakes in the accounting office?
Better than that, they got amazing social media exposure and acknowledgement. And I also want to compliment your team, Cherie, on the Superfly fun way that you presented the personalities of our team. It was really, really fun to watch, so thank you, guys.
And that's on YouTube. You can get each one of them. Not YouTube, Facebook. Facebook.
The
they're all out
videos
there.
are awesome.
And Jolynn, I want you to know that what you're doing is not going unnoticed. I'm here to tell you, you are making such a positive difference in our accounting department. Thank you very much.
The fresh set of eyes helps. We had that RFP for this, the short-term rentals out there, and everything came back 6 figures. And Cherie goes, no. And the governing body added the one position within first the compliance, and she's on a mission right now, and her mission is to find out every short-term rental in the city. And I think she loves her job too.
Cherie, that will help us move the needle. Thank you very much.
Mayor, that's all I've got today.
How impressive. How impressive. Any other questions, comments?
Yes, sir. Hey, thank you again for everything. I know it's been said a couple different times. Growing up at C of O, it's one of the big things around there's financial responsibility, and it's no surprise that you got a C of O alum leading the charge there. But financial responsibility is so important, and I'm thankful as a resident and as a member of the committee that to know we got professionals that know what they're doing, are lighthearted, easy to work with, working towards transparency, and helping us carry the financial future of the city forward, because we can't deliver world-class tourism to our guests if we don't have our affairs in order. And so that progressive, forward-thinking, deliberate plan that you are putting together is greatly appreciated.
Thank you for that, Alex. Very well said. Anybody else? Hearing none, I would entertain a motion to adjourn.
I'll make a motion to adjourn.
We have motion second. All in favor, say aye. Aye. Opposed, same sign. Ayes have it.